Our portfolios target three things. The first is the outcome, a real return, which is a return in excess of inflation. Secondly, we work to make the journey to the outcome as palatable as possible, and we do those two things because we understand how important it is to keep clients invested. And so when we position our funds, when we build them, we do so from the perspective of creating a portfolio that we believe will give us the best probability of achieving those three requirements. As a result, while many people we speak to are only just waking up to the fact that the market has done well and adding to their equity holdings, we've done the opposite. We added to equity risk way back in the second half of 2015 and early 16 when markets were under pressure and therefore cheap. As the markets have risen, we've taken profit and removed some of these equity assets off the table throughout 2017. In a world where government bonds remain extraordinarily expensive, the key question is where to put these profits to work, and we've made allocation to a number of lowly correlated strategies such as liquid alternatives and cash, depending on the mandate in question. And this ensures that we have a balanced suite of good but different returns drivers in the portfolio. Indeed, in the funds we're also able to take advantage of buying put option protection, and this exposure essentially reduces our sensitivity to equity market falls but leaves us able to take the upside. It's akin to a form of insurance and it inevitably comes at a cost, but as volatility is low, the price of options is also very low, and that means we can buy this insurance at historically cheap levels. So in essence, we remain positive on the global economy and on global markets on the whole, but given how far markets have come lately, we think it's right to take some profit and wait for markets to come back to a reasonable level before dipping our toe further. The funds performed well in 2017. Over the course of the year, the funds returned between 3.5% for Focus 3 and 8.1% for Focus 5. And to provide some context, over the same period, the UK stock market returned 11.7%. Inflation was higher in the UK than we've been accustomed to of late, at 2.7% for the year, and the Focus 3 was a couple of percent behind, Focus 4 about 1% behind, and Focus 5 was actually 40 basis points ahead over that period, where we can take a bit more risk. Over longer time periods, such as rolling 2, 3 and 5 years to the end of 2017, and since inception, the funds are all ahead of their respective inflation targets net of all fees. We suggest a minimum holding period for the funds as the number in the name plus an extra year. So in the case of Focus 3 it's 4 years, in the case of Focus 4 it's 5 years. And in November the range went through its 5th anniversary, and as a result we're now in a position where 2 of the 3 unitized strategies are through their minimum suggested holding period. I'm delighted to report that in both cases the funds are ahead of their target net of all fees since that inception date. The DFM portfolios have also performed well. Over the course of the year, the portfolios returned between 5.2% and 14.5%. The managed portfolios 3 and 4 were a little behind their target, whereas 5 and 6, where we have the mandate to take more risk, were ahead. Both portfolios 7 and 8 outperformed the UK stock market. Over longer time periods, such as rolling 2 and 3 years, portfolios 3 to 6 inclusive are all ahead of their inflation targets, and over rolling 3 years, 7 and 8 are also ahead of the UK stock market. In sterling terms, 2017 has been a good year for global asset classes. It was a strong year for sterling itself, meaning that returns from overseas markets had to fly into the headwind of the pound's strength. As a result, a global equity market return of over 20% in US dollar terms, which is a very good result indeed, appears as 11.7% in sterling terms. The UK market performed in line with global markets in sterling terms, which means that 2017 was a good year for equity markets here and abroad, following from a strong equity market in 2016. During the quarter, the most notable contributor to performance were the allocations to the equity markets, given the strong equity performance in both developed and emerging markets. Allocations to fixed income contributed positively, although asset allocation within fixed income was a mild drag to performance, mainly given we were underweight parts of the fixed income market. Although we don't expect a repeat of the strong returns of 2017, we believe equity markets will make further progress this year. Although valuations are in many cases stretched, the underlying fundamentals are as good as they've been for many years, and the monetary policy tightening ahead is unlikely to be disruptive, but more a welcome confirmation of some return to normality. Not yet the old normal, but no longer perhaps this new normal. There are risks ahead, and from these levels, longer term returns are likely to be relatively modest. However, this cycle is particularly long, and we do not see evidence of overheating and a premature downturn. Opportunities for returns outweigh the risks, and it will be important to stay invested while the inevitable return of periodic bouts of weakness in equity markets will present buying opportunities. With careful diversification, making use of the increasing range of asset classes which exhibit relatively low correlation with traditional assets, 2018 promises to deliver at least mid-single digit returns, albeit with bumps on the way.